We're going to start talking about stocks now. And stocks and bonds are related in that they're both securities. And they also tend to price the same, which is they take a look at least from a financial perspective, the expected future cash flows, and you are going to pay the present value of that, and that should equal the stock price. So we're going to talk through some of the valuations for stock price. You're going to see a lot of this is very similar to bonds. So there's a couple different types of stocks. The first one is preferred stock, which is a hybrid security. It feels somewhat like a bond and somewhat like a stock. It's similar to bonds in that it's got a fixed dividend payment. And it's similar to stock, common stock, because those dividends might not be paid if the company doesn't have enough money. And there's generally no specified maturity date on those. And so preferred stock could be outstanding for a significant period of time. And common stock is essentially the bottom of the capital stack, and that's the owners of the corporation. So when you buy stock in Amazon or Boeing or IBM, you own part of that corporation. If you have preferred stock or bonds, you don't own part of that corporation. You are entitled to certain cash flows. But for common stock, you're the owner. And so what happens is you have the entire capital stack starting with your senior secured debt, and it runs all the way down to common stock. And each one of those elements, senior secured debt, junior secured debt, senior debentures, subordinated debentures, preferred stock, all have contractual rights to cash flow. And any cash left over, once all those contractual requirements are met, fall to the common stockholders. So you can do really well as a common stockholder if the company is doing well, or you can get nothing if there's not enough cash to flow all the way down the capital stack or flow all the way down the waterfall to the common stockholders. Here's a few features of preferred stock. It's got a par value, which is the nominal or face value of the stock, similar to a bond. It has cumulative dividends. So if a dividend doesn't get paid in a current period, it gets added and accrued and essentially sits there, and it needs to be paid not only the current period preferred dividend, but any periods that were missed prior before you can pay any common dividends. And it has no specific maturity date, so you can issue preferred stock and have it sit out there for decades. Preferred stock, as we talked about with the capital stack, preferred stock has priority to assets and earnings. So preferred dividends are paid after interest on debt is paid. Preferred dividends must be paid before common stock dividends are paid. So if you have preferred stock outstanding, you can't pay any dividends to the common stockholders until the preferred dividends that are contractually required are paid. Generally, preferred stock does not have voting rights, which means it doesn't have any ability to control the firm. Sometimes this changes depending on the contractual arrangement or depending on the dividend structure, or if dividends haven't been paid for a certain period of time. Sometimes preferred stock gets super voting rights, but in general, as long as the dividends are being paid, there's no voting rights for preferred stock. And convertibility, preferred stock sometimes can be converted into common stock at the option of the investor, similar to convertible bonds, and for similar reasons. Sometimes there's a real benefit associated with a company that's going, accelerating really fast, and the growth is going well, and a preferred stockholder may want to convert to common. But similar to conversion of a bond, which we discussed in the last chapter, when you convert preferred stock, it's a one-way door. You convert from preferred to common, you can't go back. There's a few other provisions for preferred stock. The first one is a call provision, similar to a bond, where it gives the issuing company the right to call the preferred stock in for redemption. So they could say, after a certain amount of time has passed, that for X dollars, we have the right to repurchase any or all outstanding shares. There can also be a sinking fund similar to a bond. So that will be money set aside that will either exercise the call provision, will buy it on the open market, or be set aside for some future point in time to be able to repurchase those stocks once a call provision is open. And then sometimes you have participating preferred, which is where preferred stockholders participate with common stockholders in distribution of the firm's earnings. So those start to feel like more like common stockholders for the purposes of profit distributions. And so if the company is extraordinarily profitable, participating preferred shareholders may get, not in addition to their preferred dividend, additional dividends. Common stock has a few features as well. Common stock is the most common type of stock, thus the clever name, that you find on things like New York Stock Exchange and the NASDAQ. And common stock has a few things. It has par value usually. That represents the stockholder's minimum financial obligation in the event the corporation is liquidated. So if a company has common stock with $2 par value, that's the amount that a stockholder must have in the business if it's liquidated, and that's generally the default piece. As a practical matter, most companies now issue stock with no par value, so that's permitted. And the concept of par value is really an old one that has kind of gone away over time. Dividends. So the way a common stockholder gets paid is they either resell their stock for a capital gain at some point in time in the future, or they receive a dividend, which is a distribution of the firm's accumulated earnings. But a company has no legal obligation to pay common dividends, and those are declared by the board. And again, with common stock, there's no specified maturity date, so common stock can be outstanding in some cases for hundreds of years. We've talked about the capital stack a few times, and for common stock, the common stock is at the bottom of the capital stack. So priority to assets and earnings. Dividends can be paid only after interest on the debt and preferred dividends are paid, and it is at the very bottom of the list. Control of the firm, voting rights. Common stock has voting rights usually. There's a few exceptions. But common stock has voting rights, and they elect the firm's directors, and they can vote on various proposals. Generally, when you elect a firm's directors, the directors then comprise the board. The board then hires the management team, and the management team runs the company day to day. So if you're a shareholder in Amazon, you vote on the board of directors. The board of directors then appoints the company officers. The company officers then hire the employees, and that's how corporate governance works in theory. Common stock usually has a preemptive right. So if you have common stock outstanding and the company goes to issue new common stock, additional common stock, you normally have a preemptive right to purchase additional shares of stock before they're offered to new investors. As companies have moved into high tech and you start seeing more venture-backed and private companies go public, there's a couple other types of common stock as well. So we've talked a lot about typical common stock, and that's the has the voting rights, etc., that we talked through. However, you can have also classified stock, which is stock that's given a special designation like Class A, Class B to meet special needs of the company. And so, for instance, Google has, or Alphabet has, classified stock, and so the founders continue to have, and this goes to founder shares as well. The founders continue to have disproportionate voting rights with respect to that stock. Other classified stock that's out there, there used to be stock called GM, General Motors, and then you had GME, which was General Motors EDS, and GMH, General Motors Hughes, and each one of those classified stocks followed a different business segment of General Motors. So you had General Motors, the parent company, then you had one that was specialized in data processing, and it got dividends and had valuation based upon the data processing business. And then you had GMH, GM Hughes, which was based upon their avionics, aircraft, and controls business. And each one of those had a tracking stock, which was essentially a different classification. When you have international markets, you have different types of stocks. So you have ADRs, American Depository Receipts. So that would be stocks like Barclays, which are issued on the London Stock Exchange, and then a bank in the United States takes a bundle of those and bundles them into shares and resells them as Barclays ADRs. And so those are certificates created by banks which represent ownership of stock on a London Stock Exchange, for instance. Then you have foreign equity. You have Yankee stocks, which are stocks of a foreign company traded in the United States. So you may have certain companies that are incorporated outside the United States, like Unilever, which is a Dutch company, and that's traded in the United States, and it's traded in U.S. dollars. And so it's traded on the New York Stock Exchange in U.S. dollars, so that's a Yankee stock. You may have Euro stock, which is stock traded in a country other than the company's home country, except the United States. And so you've got situations where, like IBM will trade in the London Stock Exchange or in the Frankfurt Stock Exchange, denominated in euro or in pound sterling. For stock valuation, again, we've talked through this. It's very similar to bond valuation. So again, if you have questions around time value of money, go back to chapter 4. If you have questions around bond valuation, go back to chapter 6. But stock valuation follows all the same principles. So D hat sub T is the dividend expected to be paid at the end of each year. P hat sub T is the expected price at the end of year T. P sub 0 is the actual price of the stock at year T. G is the expected growth rate in dividends. R sub S is a required rate of return. R sub stock is required rate of return, the minimum rate investors demand to invest. So here's a few basic formulas when you're expected, when you've got calculations to make. You've got the dividend over the price is the expected dividend yield in the coming year. So you divide the price into the dividend. That's the dividend yield. The capital gains yield is the price in the future minus the current price over the current price. And the actual price of the stock at the end of the year is R hat sub S. So we'll talk through a few stock valuation models. If a stock's expected rate of return, R hat sub S, is greater than or equal to the investor's required rate of return, R sub S, the stock's a good investment. So essentially, if R hat sub S, if your required rate of return, or if the expected rate of return is greater than or equal to your required rate of return, it's a good investment. If your required rate of return is greater than the expected rate of return on a stock, it's a bad investment. And that's pretty straightforward. If you take a look at a stock and you say, based upon the risk profile of this stock, I need to get 10% rate of return on this stock over the next year. And when you take a look at the dividend yield and the expected capital gains yield over that course of the year, and it comes in at 9%, it's a bad investment. So expected dividends are essentially the basis of the stock value. So the challenge you run into with stock is there's no maturity date, right? So you're going, okay, what's the value of a stock? If it's the expected future cash flows, it's the present value of the expected future cash flows. I need to know what the expected future cash flows are, but I don't know when the stock's going to go away. I don't know what the dividends are going to do in the future. Once you get out to infinity, that's an awfully long time. And so, geez, I'm not quite sure what the, kind of how to calculate this, because just like we've done numerous times, you got your required rate of return, you discount period one's dividends and period two dividends, and you keep going, but then you go out to infinity period infinity's dividends. At some point, this exercise becomes very difficult. And so reducing this to a formula is going to be much easier than trying to use a return timeline. So stock's value, V sub S, is equal to today's price. And today's price is equal to, as we saw, essentially the summation of the expected dividend at a future point in time over the required rate of return to whatever power the the number of t's are. So t is 1 to infinity. And this looks identical to what we had in the bonds. And so in order to figure out what the expected future dividends are in these periods, we have to make a couple assumptions. We're going to assume that those stocks are that it's going to grow, or it's going to stay the same, or it's going to decline. Any one of those three can be factored in the form of an equation. So if growth is expected to continue for the foreseeable future at about the same rate as the economy as a whole, we'll use G, a constant growth, stated as a decimal. So where G is the expected growth rate of the economy as a whole, you now see that we can go, okay, the expected dividend growth rate is going to be today's dividend times the growth rate to the first power, times the growth rate to the second power, times the growth rate to the first to third power, etc., all the way out to infinity, over 1 plus the required rate of return on the stock to the first power, second power, just like you see in a bond. The difference is, of course, at the end, you don't have a fixed amount for the number of periods, and you don't have a plus the return of principal. However, from a math perspective, that allows us to actually reduce this complex equation down to something relatively simple, which is the expected dividend at the end of period 1 over the required rate of return minus the growth rate. That's the value of a constant growth stock. And again, I'm not going to go through the entire mathematical equation on how you reduce this down to this equation. You can trust me on this, that the expected dividend at the end of year 1 over the required rate of return on stock minus the growth rate will give you the value of a constant. Present value of dividends of a constant growth stock. If the dividend is $1.60, the growth rate is 5%, and the required rate of return is 20. Using this formula, you end up with a valuation of $11.20. Constant growth, when the growth rate is equal to 0, so there is going to be no growth rate, it's just a dividend over R. You essentially, if this is 0, you've got 1 plus 0 is 0, so it's dividend over R sub S minus 0, so you have D over R plus S, or R sub S. The expected rate of return on a constant growth stock, R hat sub S, is the expected rate of return. The expected dividend yield, so you're going to have the dividend at the end of period 1 over the price today, plus the growth rate. That gives you your expected rate of return. Valuing stocks with non-constant growth. So non-constant growth, you've got a stock where it takes 2 steps, although you could do it in multiple steps. The bulk of what you're going to see in the class and in reality is going to be a 2-step process. There's part of the life cycle where the growth is much faster and much slower than the economy as a whole, and then it settles into the economy as a whole. So if you do that, you're going to start computing dividends that are expected to be paid during a non-constant growth period, which is generally going to be at the beginning. So you're going to say, okay, from period 0 to period 5, let's say, there's a growth rate at 10%. And so you're going to calculate and do the present value on that just like you would for a bond. And then you say, okay, past period 5, you're at a constant growth rate. So then you calculate based upon the way we just calculated constant growth rate dividends, and you'll bring that in at the end of basically the beginning of period 6, and then you'll discount that back as a lump sum. Back to period 0, you'll add the two together, and that will give you your final answer for the current valuation at that required rate of return. So you start computing dividends that are expected to be paid in a non-constant growth period. You continue computing dividends until you compute the last dividend that's affected by non-constant growth. Using the required rate of return R sub S, compute the present values of all the non-constant growth dividends, and then sum the present values. Then you can compute the first dividend that is affected by the constant growth rate. Use the first constant growth dividend to compute the value of the stock at the end of the non-constant growth period. All future dividends will grow at a constant rate G normal. A modified version of the constant growth equation is used to compute the value of the stock at the end of the non-constant growth rate, which is P sub T. and then you find the present value of P sub T. Then you sum the results of step 1 and step 2, and you find the intrinsic value of the stock at period 0 today. So let's walk through an example. Dividends will grow at a 20% rate for the next 3 years. So for the next 3 years, it's going to grow at G1, G2, and G3 is equal to 20%. Beginning year 4, dividends will grow at 5%, which is going to be the constant growth rate. And that'll continue for the rest of the firm's life. So from G4 all the way through to infinity is going to be at 5% per year. The last dividend paid was $1, so the dividend at D sub 0 equals $1, and the required rate of return is 15%. So how do we calculate it? Well, the first thing we do is we calculate the non-constant growth dividends. So you have dividend 1 is $1 at a 20% growth rate. That's $1.20, $1.44, $1.72.8. So you're going to compute the present value of the non-constant growth dividend. So again, this is the same formula that we use for bonds. So you've got the required rate of return to the, essentially to the end period. So this is first period, second period, third period, the amount at D hat sub 1, D hat sub 2, D hat sub 3. You add these together, you get $3.26.85. Then you compute the first constant growth dividend. So we had $1.72.8 was the dividend at period 3. So the dividend at period 4, now that we're into the constant growth 5%, you multiply $1.72.8 times 1.05 gives you 181.44. You use that amount to compute the value of the stock at the end of year 3, which is the period at the end of the non-constant growth period. So you say, okay, D hat sub 4 over, and you're back to that last formula, over the return minus the constant growth rate. So you calculate that, and it comes to $18.14.4. That's the present value at period 3, or the price at period 3. Then you have to discount that back to today. So you take the $18.14.4 and you put it over 1.15 to the third, because again, you're in the third period. That gives you a value of $11.93. And then you add those together. So you have the $3.26.85 from the 20% growth phase, and then you've got the $11.93 present value from the constant growth phase. It goes from period 4 to infinity. You add those two together and you get $15.19.85, or $15.20 would be the value of the stock based upon finance principles. So you can see its intrinsic value of the stock at this period. Now, the question is it actually going to trade at the intrinsic value? And the answer is probably not. However, if you've calculated this based upon your required rate of return, if the stock is trading at $14 and you think the intrinsic value of the stock based upon your analysis is $15.20, it's probably a good buy. If you do this analysis and the stock is trading at $17, then you probably think the stock is overvalued based upon your intrinsic value of the stock. And the critical piece is going to be, your critical inputs are going to be, how quickly do you think the stock is going to grow? What do you think the constant growth rate is? What's your required rate of return? And so it's these percentages tend to be, they're the ones that are driving all the equations here. And this is where, as a financial analyst, you'll spend most of your time. You'll spend most of your time trying to figure out, is this 20% right? Is this 15% required rate of return right? And is this 5% constant growth rate right? Because with those three, you're going to get this valuation based upon that $1 dividend that was paid in this last period. You'll come up with an intrinsic value of the stock, $15.20, and then you'll be comparing that against the current market value and going, okay, now, what do I want to, is it higher or lower? And does that mean I buy it or sell it? So there's a few other stock valuation models that you'll see sometimes on Yahoo Finance or other places. There's price to earnings ratios. Generally, the higher the price to earnings ratio, the more investors are willing to pay for each share of the firm. A PE ratio gives an indication of the stock's payback period. So price to earnings ratio, market price per share of common stock, divided by earnings per share. There's also economic value added. Economic value added is EBIT, which is earnings before interest and taxes times 1 minus the tax rate. So this is the amount that's available to common shareholders, minus the average cost of funds. So this is a percentage basis, times the amount of invested capital. So essentially, what's your cost of funds times the invested capital? That gives you your economic value added. So if EBIT, cash available, is greater than the cost of funds, the cost of the funds invested, you're driving economic value added. This number will be positive. If, however, EBIT is low and you've got a bunch of money invested in the company, then EVA, economic value added, is negative, and you obviously want economic value added to be positive. It's essentially another measure of whether your return on assets or return on equity is a good or a bad number. Changes in stock price. Prices tend to move in opposite to changes in rates of return. So if a required rate of return goes up because risk goes up, or other market factors cause the risk-free rate, which we'll talk about here shortly, to go up, then stock prices will go down. If the risk-free rate or other factors involving risk cause the rates of return, required rate of return to fall, then prices will move up. Prices also move in the same direction as changes in cash flow expected from the stock in the future. So if you expect that dividends would be at $1, $1.20, $1.44, like we saw in the example, and then you've taken a look and you go, it's not going to grow at 20%, it's going to grow at 25%. So now it's $1.25 and $1.75, for instance, then the price of that stock is going to go up. Again, if you think about stock as being the present value of the expected future cash flows associated with the dividends, if the expected future cash flows rise, the price will rise, all things being equal. If the rate of return rises, if the required rate of return rises, the price will fall. If the required rate of return falls, the price will rise, just like a bond.